Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
All right, we're live. Got a full house today. Andrew, do you have some good news for us?
Yeah, I guess it's good news. The Tesla Optimus robot.
This is the man in the suit.
Yeah. It's been pretty underwhelming today, but they had a new video and it was, I have to say the video is underwhelming. When you're used to the Boston Dynamics parkour backflip kind of videos, it's sort of like you see this robot sorting green and blue cubes between trays. Like, I feel as though we've conquered that. It's interesting in the sense that the way that is programmed to do that, in the sense that it's not programmed to do that. So it's basically taking the AI engine that the cars use to drive, and it's just basically watching a lot of videos and then training itself how to do that. So it's kind of pretty cool in the sense that what it means in terms of the versatility of this machine, essentially. It's like in a former era, I had to sort of specifically program every single last movement and contingency and the rest of it. Now it's like, just watch a bunch of this and you figure it out. And so that's kind of cool. So it's sort of, we're slowly progressing towards our robot demise.
Yeah. So it was yoga. Was this what it was doing? Was that the main?
There was a little bit of a gimmicky yoga-y thing at the end there. But if you sort of
how does every good news segment turn into like, and our robot demise is just around the corner? Yeah. I got some good news for you, guys. None of us have COVID right at this very moment. So, digital high five. Yeah.
Yes.
I've got a little bit of good news that we could come up with. It's going into spring. We should all be able to enjoy a few months of beautiful swimming weather before the fiery heat of summer destroys us all.
So negative. Australian summers are amazing. Everyone comes to Australia for the summers. It's good.
We need to rename the segment like good news / bad news ? Question mark.
I thought that's what it was. Anyway.
All right. What about some other news? Not really good news necessarily. I'm not sure. But there's an article about property.
This is hilarious news. It's old news now, though. You probably all saw it already.
Yeah.
This was 18th of September.
Yeah.
The Kook, Stephen Kukless, economist to the boomer class, basically came out and said, I kind of fell off my chair a little bit here. It was like, why house prices need to rise to fix affordability. Now,
the solution is always house prices going up.
No, it's just sort of like if your initial reaction to that is WTF, I feel as like that's the correct one, because it feels like to me, and again, I know I'm not the brightest spark, but it's just like affordability doesn't get better when house prices rise. The argument here essentially is that, the poor old developers, there's not enough of a margin. So why would they build? If they don't build, there's not going to be enough supply. There's not enough supply. That's going to keep pushing house prices up. And if you're now going, wait, isn't there a circular logic to this that doesn't make sense? I mean, wouldn't that push prices up and therefore incentivize developers to, et cetera, et cetera? It doesn't make any sense. I'm sorry, Kook. I'm sorry, buddy. It's just sort of, and he got rightly lambasted on Twitter. And anyway, I just thought it needed to be called out.
So his argument was,
we need
prices to rise so that we get more demand and then prices will fall.
Yeah. Yes. And I feel as though it's like
supply, I should say.
It's a bit like the underpants gnome meme. Step one, house prices go up. Step 2, question mark. Step 3, affordability. Like, huh?
I want to get you on the property ladder, Andrew, so badly.
I think it's an escalator now, isn't it?
I think it's a rocket, right? Isn't it?
I keep on pitching Andrew my best real estate buy ideas, and it just
not going to happen, dude. The other argument he's got in here is that the building costs have gone up a little bit, which is also contributing to the problem. So it's interesting. It's like only a fiat economist, right? It's not a matter of like, well, maybe building materials why are they high and what could be done to do that? It's just like, no, let's just put the sticker price up and that'll fix it all.
You're thinking about this the wrong way, Andrew. You're supposed to think, how can I make money out of this?
Well, you explain to me. Explain to me like I'm a 3-year-old.
I've been waiting for this intro so
There you go. I'll tee you up, my friend. Go for it.
If you guys want to do it with me, hopefully some listener, reach out and we can do the plan. But basically I found some really good land for maybe 350K, hopefully get it down to 300. What you do is you buy this land, it's kind of remote. You use my friends who have a company that does prefabricating building, and like the building costs is a lot less than like, you know, the traditional builder that'll build your house. Build an eco resort. So in the meantime, everybody has like, you do have like you have cabins, you plant an orchard. So that takes 10 years or 15 to fully mature, but you take care of it. May have to pay a little bit of money to someone to take care of it. Ideally, you can find someone.
Unless they work for Apple.
No, it is May, because the reality is you've got a lot of accommodation in a beautiful location. It's quite likely you can find someone to live there, look after the garden, and for free, so you may not have to pay.
Free labor, okay.
It's not free.
I'm listening.
They're getting a place to live.
Actually, Claude was good. The next part was going to ask if you wanted to live at the orchard and work his land.
Yeah.
In the meantime, you have like a sweet, you know, venue or whatever for whatever you want a venue for. But then you wait till like the next, you know, time when billionaires are freaking out or whatever, and you sell them like the escape hatches individually, as it were. Like, I don't know how you do that exactly. This plan's yet to be fully
So while the world is burning and the zombies are running rampant, I'm selling my property to billionaires and like just going to join the horde, or
you got to wait until the end of the next La Nina.
Okay.
So when the fires are furthest from people's mind, that is when you sell your bush property. And when you buy the bush property is at the end of the current El Nino we're going into. Presumably half the country is going to burn. You're going to have all this like panic sales of land. Get land with a river on it, obviously. Mm-hmm. And yeah, that's the plan. You got to play the cycle.
I'm gonna put that in the maybe pile. How about that?
So close.
I guess, well, two thoughts with this whole news. I mean, one is he's probably just trolling to get talked about because we're talking about him now. And it feels like that. Who's that other guy that went like globally viral? The same guy that invented the millennials eat too many avocados guy. He went viral again like 2 weeks ago.
Or whatever his name is.
Yeah. I feel like they know how to, you know, they push the button of outrage a bit. They're okay being the bad. They're like the bad guys, you know, in pro wrestling. They're like the heels who like everyone like.
I want desperate workers, he says.
I think that is a reinterpretation to make themselves sound less dumb than they are. It's like they said the quiet part out loud. It's like, oh no, it's actually like 4D chess because what I really do. No, it's not. No, it's not.
But the other thing is, I guess I do agree that we need more supply. But I think that I don't think we need prices to rise. I think we just need zoning. I think that's what I'd mentioned before.
It's
so much of the cost is zoning related. Like if you just made it really simple, zoned for a lot of like medium density houses, and made it really simple for a property developer. Claude would be there. Claude would be building some eco resort versions.
No, I'm selling into the zoning uplift, mate.
Yeah. Zoning, I think rezone to make it more dense and also just make it way simpler to get zoning approval. Yeah. I think that takes so much of the cost and risk. Like all the financing cost is increased.
Think about it like this, right? You got someone whose family owns an old house. They get a huge uplift when their thing gets zoned differently. The reason they get that uplift is because they're not zoning very much differently. They're just doing it an extra, 10 blocks when they should be doing 100 blocks. If you did 100 blocks, that uplift would be spread over more people. Instead, it just goes to a smaller select pool of winners.
Yeah, I don't get that. But wouldn't it, if I've got my beautiful leafy suburb with lots of space and yards and then I'm like cramming more people in there, doesn't that lower the value of the appeal of that suburbd?
It lowers the value of a house, but not of land. So the land becomes more valuable per square meter.
We just sold. We got overbuilt at the house you've been to, Andrew. We got overbuilt, built by apartments and stuff. So then you end up selling, and you're selling for the land. Like the land has a value. The house has no value.
So what you saw in Auckland. So Auckland's done this. They rezoned basically the whole city. They like aggressively rezoned almost everywhere. Prices rose initially, but then they flattened because you have all the more supply coming on. But this is price of houses, not of land. Like price of land didn't really change much. Well, I mean, just think about it, right? You're doing some research. Doing some research on the fly. Let me find a paper that justifies what I'm saying. But it makes sense, right? Like if you can suddenly build a high rise there, then the land, if you can build it as well, like if only your neighbor can build a high rise, your property is less valuable. But if you can build a high rise now, suddenly your property could have a high rise on it, which means
But the way they do it now is like, if they ever do rezone stuff like that, it's like the smallest little area of some developer who bought it and gave a donation to the Liberal Party or whatever it is.
Yeah, so you want to rezone a lot, but you also want to just make it really simple, because that simplicity is a huge. When you think about a developer, right, you have to buy the property you're going to knock down or do whatever you want, or empty land, and so you have to buy it. That's a lot of money, and you have to finance that for the whole time you're waiting for planning approval. And so and you have that risk. You have to have the risk of like knowing that you can get approved, which opens the door to all sorts of low level corruption and that kind of stuff, to like have a nod and a wink from a friend. If you make that really simple cookie cutter approach, you just open the door to a lot more people to develop. It's lower risk, therefore lower cost. Yeah, you just flood with new homes.
I agree that plan would work.
All right, well, I'll be holding my breath on that one.
The other way you do it is you just have the government build a whole lot of public housing, and it's not done for, like in Singapore. Have you read about the Singapore system? They have a housing development board. It owns a huge amount of the apartments on the island, on the area. They're not run for profit, so they will do various deals. There's long-term rentals, there's buying. They'll sell a practical multi-bedroom apartment that can be like a family home for life kind of thing, and then they'll just take that money and spend that on building more apartments. And yeah, it's just a government owned, it's like having a big government owned property developer that then just sits in the market and tries to keep the prices as low as possible. And then they're also super punitive about say foreigners owning any property. And that's another way to free up supply for the local population. So, yeah, there are multiple ways to do it.
Can I reduce my excellent research? So I totally hear what you're saying, Matt. So the 2016, 2014, there was big changes to zoning reform. And you see this massive improvement in supply.
It's about New Zealand?
Yeah.
Auckland?
Yeah, Auckland specifically. So it checks out. In fact, house prices continue to rise in the years after that. But as those properties have come online, actually since 2021, house prices are down 25%. So good, right? Like, I mean, just from a society point of view here, housing was unaffordable. It wasn't enough. They increased supply. Lo and behold, prices came down. That feels to me like very year 9 economics kind of rational kind of stuff. So I do like where my conspiracy theory would kick in. It's just sort of like, why would I ever want to instigate a property where I'm going to eventually lead to a 25% decline in prices? Don't think
it's 25% off the high. Like if you compare it to the pre-intervention price, it's probably still quite up, because that was done in 2014.
That's why you have a public property developer, a government that will add to supply, even though that's ruins profits.
Yeah, but it's basically a lot flatter. Like it just hasn't risen
more or less flat since 2017, right? So it's
that's ideal. That would be the ideal scenario, right? If you have it intervened, you don't have anyone complain that their house lost value. You don't anger all the existing stakeholders. You just have prices just stay flat from here for the next decade. That would be an ideal scenario, I think, to solve the problem.
Not for a lot of
property investors. Yeah,
not for someone who's like negatively geared out.
You don't have any crash. You just have like more supply.
It is the best outcome. Yeah.
All right.
Anyway,
we've solved it. Listen to this podcast. All right, should we go on? What other companies do we have in our sights?
News about Pro Medicus. More good news, of course.
Breaking news
as we're recording this.
Mm-hmm.
You guys, this happened a few days ago when you're listening to this. But it looks like Pro Medicus has signed its biggest ever contract. So nice.
Biggest by a pretty significant margin, it looks.
Nice.
Yeah.
Obviously, disclosure, I own Pro Medicus. So full stack, that's great. Isn't it ironic that this company started out by, copywriting the term, I think, I don't think you do that, but they...
we don't need to revisit every journey of the buyers. This is what let's talk about the news.
It started with them getting in deconstructed packs, basically, where they were just the viewer, and that was their edge. And now they're like habitually selling like the whole stack.
Mm-hmm.
So that's pretty cool, and that's, I guess, the main thing to call out. Really, otherwise, there's nothing else to it other than it's just. Oh, by the way, the catch. Part of the reason it's so big is it's a 10-year contract, whereas previously they've done sort of mostly 6 or 7 year contracts. I think.
Do you think the gross margin would be the same, Claude, if they're doing the whole stack for this one?
The overall, I would say that if they have done a bigger, longer deal, that is going to end up with more competitive pricing for the buyer. For sure. I think I know the way they work. And if they're like saying, hey, we've got a 10-year sign in now, that is the kind of behavior from customers that they would want to incentivize. They're also similar to their ethos of renewing customers get a discount.
Mm-hmm.
So they want to incentivize long tenure. That's always been part of their game.
Yeah, gotcha.
So
Excellent.
that's a guess, by the way. I have no idea, pure speculation, but that would be my guess. If they didn't, then awesome.
It's another good reminder, structural change coupled with outstanding capital management and favorable unit economics. There's a lovely triumvirate of factors there that can lead to multi-bag
Remember we
decade-long
thought
returns.
It was crazily priced when it was $15?
I do. And 20 and 30 and 40.
So much selling. Anyway. Yeah. All right, moving on.
All right. What else? What else we got?
So I thought we could jump to a relative baby as part of the Baby Giants podcast. Another company that is also cracker, just because I guess it's a nice, good mood to talk about companies that are, trading near all-time highs. Supply Network is
it's definitely small cap these days.
So it's another one I own shares in. Do either of you guys want to give the intro about what it does, or should I jump in?
It's a bit like the Bapcor of trucks and buses. Is that an easy way to describe it?
I think that would be a great one-liner.
Yeah, it's what's really nice about it. It's a family-run kind of business. It's another example of just incredible growth. I mean, the per share earnings have grown substantially over the years. The share count has remained flat. They achieve outstanding and growing return on the equity. And they do this while investing for growth. I mean, that is the key kind of thing, I think, here. They are long-term thinkers, to my way of thinking. They make decisions go beyond the next quarter, which is depressingly rare. And they've done it. It's where they remind me a lot of Objective Corp in a lot of ways. Nothing, the businesses couldn't be more different, but just in the sense that able to sort of achieve very significant, consistent per share earnings growth while keeping the share count flat, while paying ever-increasing dividends. I mean, the dividend was 10 cents a share in 2017. It's close enough to 50 cents.
Andrew, how have you not mentioned that you recommended it to Dividend Investor so many years ago?
Because I didn't buy it myself, Claude. That's why. That's why I don't mention it. Yeah.
But I'm happy you put it on my radar because I did definitely.
Yeah, and then because God, this is actually what's really nice about this. Well, besides the returns, which are insane. But I made this point recently, speaking of Objective Corp, and there are others out there, they're rare, but they're not that rare, is that you often think that to get these incredible returns, like multi-bag returns, is that you just had to have been so early that it almost borders on luck. Pro Medicus is actually another good example, right? Where actually, if you go back in the day, these were companies that had free cash flow, they had growth, they ticked all the boxes. It wasn't as if, you never could. I mean, let's be real, you never could have imagined perhaps the degree of growth and the multiple re-rates and the stuff that sort of helped drive the significance of the returns. But it wasn't. You didn't have to be Nostradamus to say that actually there's a very decent, viable, attractive business here, which is on a growth trajectory, and they're out there, and what happens is that no one's interested in them because they're too small and they're too illiquid. We interviewed Ian Castle recently for Strawman. God, he's such a legend, that dude. And he's sort of making the point is that, there is a pond that you can fish in that this quote unquote smart money just won't or can't more often. And, it takes a bit of work. You turn over a few stones, but there is a lot of examples of these kinds of ones, the Supply Networks, the Objective Corps, the Pro Medicuses, then other examples that I know you guys will be able to throw out there. And the other lesson, again, I know I repeat myself here, is that it's very easy. You look back and go, oh, wow, Supply Network, $15. Gosh, if only I bought it, 10 years ago when it was at $1 or something like that. Look how incredible it would be. The reality is that it tends to be, it's always a gradually then suddenly phenomena. In that you buy these things and just it feels like forever that nothing happens with the share price. And then it happens all at once. And then it has this massive retracement from the high. And then nothing happens for another 2 years. And then it happens all again at once. It's sort of like it fits and starts. So I guess summarize here. My point is that you will find companies that tick a lot of boxes, and then it'll feel as like you're taking crazy pills because no one else seems to see it for years and years and years. And then it'll happen all very quickly. And then it'll get all very scary as it retraces down. And this is sort of why, even when you are someone who may have been able to identify it early, that you might be the exception to the rule. An even bigger exception to the rule is the person who can hold for the duration and enjoy the spoils of that work. So it's finding it. Okay, that's a bit of work, a bit of effort, a bit of foresight. sticking with it, that's even harder.
Matt, once I never know if you were serious or flippant, but I remember once you told me never sell a multi-bagger.
I mean, if it's going to keep being a multi-bagger, yeah.
Oh, you left off.
It's like never buy a stock that goes down.
That's what I've been
Wait a
doing
second,
wrong.
I was buying more brain chip because Matt told me to buy more brain chip.
No, I think it's a good point. I think, the market's dominated by these few companies. It's a power law. These few companies that generate almost all the returns over the long run. But it's really hard to get to the long run because you have to face these drawdowns. And the whole industry, like, it's very easy to say investors are too short term, but it's like everything is structured that way. It's like, everyone thinks they're long term until they get, punched in the mouth, until they have a drawdown. And suddenly like, oh, I should have sold at the top. Oh, what was I thinking? And then everyone else like, oh, look at that trend line. It's obvious you should have. It's just the whole everything. Everyone wants it to be good all the time. And I think you summed it up well, Andrew. You have to have these big retracements and stuff, but you also need to know when the story changes. So it's not easy.
So that got philosophical for a bit, but I guess to revisit Supply Network. So essentially, to give a little more detail, they are a distribution network that specializes in first bus and then truck parts. So as Andrew says, a different version of the kind of Burson model. But instead of being involved in sort of more retail, it is really a business to business company, because obviously most of the companies that own buses and trucks and all that sort of stuff, they themselves are a business, right? And basically the narrative that I think has been helping its multiple recently is that as you have an aging fleet, which is resulting from the supply crunch we had a few years ago, which meant it was, harder to get new trucks, new buses, stuff like that. So you naturally have a bit of an aging fleet. The logic goes, that means more replacements, and that benefits the people that are set up with the distribution network. What makes Supply Networks the one that I own is it feels like the stronger competitor in the field. So there's MaxiParts is actually a listed company as well, and they got a little bit distracted doing slightly different things instead of just a core distribution network, which probably helped Supply Network, which has the brand Multi-Spares. And on top of that, I think that probably Supply Network has just grown more organically and therefore, I guess, deliberately planned it out its networks. And if you go back and read its reports, a lot of time what the plan they're outlining in the next couple of years is essentially, this is where we're planning to grow. And overall, they continue to impress, but they are allocating capital. Obviously, it's a physical network. So it's not actually necessarily, a super high margin business. It's a competitive distribution business. That if we're seeing a dynamic where a little bit of extra scale and a little bit of better operations means that they just have that little competitive advantage, I think we've seen with a number of companies, distribution companies can be decent companies. It's not always going to last forever, but it certainly can, especially if there's demand tailwinds for whatever they're distributing, because it just means more volume over an existing network. I think that a apocryphal story is like when Coke was growing really strongly, Coke distributors sort of did well. And own shares myself would like to think that it's one for the long term. The reason I like to think it's one for the long term is because if you look at the track record of the business, it just says to me, honest, competent management. Which brings me to my interesting point, which is why I guess it's a little bit newsworthy in the last couple of days. We've actually seen something pretty rare, which is some selling from the long-term founder family or the directors, rather. There's a couple of directors, change of directors interest notice. However, only one of them was a sell down. And yeah, basically that you haven't seen that very often. And I think that it's always possible that's a negative. So I guess that's something to keep in mind. But then the other thing is to keep in mind as well that this is a very illiquid company, and an interest of over 50 million shares, you're seeing 1 million of those sold. To me, it's not a very strong negative signal at all. And also, I guess in the back of my mind, you always have that hope that one day your company might get big enough and liquid enough to get into the ASX 200, which then triggers the buying. Now, sometimes you see that buying beforehand as funds front run it, etc. So it's not saying it happens after, but certainly Supply Network is nowhere near that right now. If you were to see the Forsyth family, I think it is, gradually sell down a little bit, very slowly. I think that is not a negative thing. I could imagine there would be, I would hope, some long-term minded small cap funds buying that stock. Hopefully they hold on to most of that stock, getting set now for what could be, a great situation in years to come. Of course, having said that, these things never turn out smooth. And maybe if there is some sort of wider downturn, that could definitely hurt these guys as well. So, and it's capital intensive business, remember. So I'm not trying to say it's like the most resilient, best.
Do you have any thoughts on electric vehicles? Fewer parts needed. That was always kind of a bear thesis for Backcore.
Yeah.
As we move to electric vehicle, don't need as much parts. So just, less demand for this type of business.
Well, I hope that a listener will correct me if I'm wrong in this, but as I understood it, what benefits a distributor like this is the proliferation of different parts. And so, yes, that may well hurt Matt, but in the very long term, when it means like the mass retirement of the existing fleet, so the number of different parts is actually getting smaller, which I imagine would be quite harmful to their business. But as long as it's just new vehicle types, well, I would say that their margin comes from the fact that they have a network of locations that can give you a wide array of inventory. And if you look at their results, you'll see that they have a massive inventory. And I think in the meantime, until that starts, the need or the competitive advantage of that wide inventory goes down, I think it's probably not a big issue for them. And I'm not too worried about that. But yeah, I think as a long-term concern, definitely that would be a thing. And also you could argue, like, say, the trend we've seen in Tesla of them really in-housing it. If you had, say, some of the manufacturers of trucks and buses, like saying, we've got these new fancy electric vehicles and we're going to take this opportunity to like take over the maintenance and the parts and just really monopolize that vertical, that could definitely be like terrible for these guys. So a couple of risks there worth talking about.
I guess one other point more in their favor is trucks are harder to electrify than passenger vehicles just because of energy density, and hopefully we overcome it. But yeah, that was a point in Bill Gates' book, How to Avoid a Climate Disaster, was that for a long haul truck, the battery would be so much of the load that it's basically not economical. You'd have to have some pretty substantial battery swap system very regularly. So it's not overcome yet like it is for passengers. So we're not seeing that same traction yet.
It's the exact kind of narrative you would love to take hold, wouldn't you?
Yeah. Like people freak out about it too early, you mean?
That may be a bit of a sort of an economic contraction of sorts, as you said, it's not going to be great for them. Or a whole bunch of things that on the face of it, I mean, you're not going to pretend is good news, but is exaggerated to the long-term impact and
we had it with Backcore. I remember
flows.
Owning Backcore in 2015, and people were like, there was some guy who came out who said all existing cars are stranded assets. And it's like, things take longer than people realize. The other thing with vehicles is how long they last. So like if every new vehicle today was electric, it'd still take 12 years before the average vehicle was electric, like with how long a fleet lasts, like it's just a long...
And then there's still...
like a phone.
It's not like electric cars don't need parts. Like we need less parts. Okay, not no parts. People go to extremes on some of these things. The other thing we got with the Supply Network is they've said in their recent annual report as well, it's like, well, geez, we had so much growth over the last 3 years, but we need to invest heavily in new technologies. And so there's a big CapEx program, it seems like.
I love when that scares people off.
I love that. I love it. I was like, so we are laying because of all this growth that we're having to burden, we are going to invest heavily in scaling our operations and making them more efficient and allowing us to carry even more volumes and revenue in the future. I was like, oh, that's terrible. I'm just going to, the smart money, the brilliant brokers or whatever will sell down and just think, oh, I'll just buy back in once that's all done or whatever nonsense. Like, it's beautiful. You love that kind of stuff.
Yeah.
Yeah. And so Supply Network, what I'm sure you're referring to is they not only are they expanding their branches in Melbourne, Gold Coast, I think, but they are also spending a fair bit of money on like upgrading their enterprise resource planning system, which can be a bit of a risk.
Oh, that's actually one of my orange flags. Upgrade an ERP system. So ERP system, for anyone who haven't talked about it before, enterprise resource planning, it's an integral system that's like the lifeblood of a business, particularly for something like a distributor. It's very important. They often go wrong. I worked at a company in a former life where they implemented SAP for 10 years. It failed so badly, they re-implemented it 10 years later. So it's just an opportunity for an earnings miss. Not saying that these guys will, and I'm sure they're very well organized generally and prepared, but I do think there's a reason to be cautious.
Yeah, I reckon it's a bit of a worry. I think it's like they've already delayed it once if it does hit the earnings in a sell-off on that. I think Would you say that they usually get past these things, or is it once you're in the ERP hell, like you're never?
Oh no, I mean, well, yeah, not every company takes 10 years for that hell to go. That was exceptional. No, I think it's just a bump. It's just a short-term thing, hopefully. Like BWX had it similarly, I think, a few years ago. I remember them. It's something that is a positive on all the broker calls until it happens, and then it's like, for some reason, everything's going badly. And yeah, obviously, as we talked about last week, that didn't end up well for a bunch of other reasons. But yeah, so it's just a short-term speed bump thing. It could be an opportunity if companies have that kind of fail. Peter Lynch talked about a similar one for like a company opening a new factory. It's often something that gets everyone very excited and they're like, oh, more capacity, but new factories tend to lead to a lot of problems with tooling and everything else. So yeah, cool.
That come off pretty negative for a company that I quite like, but fair enough.
All right, should we move on to Siteminder? Did you guys? So we talked about this like a year ago. Andrew, you're very fresh from our conversation a year ago. I'm sure you recall everything we said.
I can't remember what I had for breakfast.
I can help you guys out. So I listened to it. I wasn't on that podcast, but essentially Andrew was saying that, this is a good sticky software business.
Has it crashed 80%? Is this the next?
It's pretty much flat. It did have a tough time. That this was in June 2022, so cash burning companies were absolutely on the nose, and it has continued burning cash. So I think that was something you raised, Matt. I think that essentially it did get absolutely savaged as it continued to burn cash, and the reason that I'm bringing it up now is not because I own shares or really plan to, but I do have to say, or like just shout out to the fact that now with the most recent results, I think it's fair to say that there's a lot more credence to the idea that they're actually going to go towards cash flow break even and then eventually profitability. And if you're happy with them as a sort of software as a service style company where it's one of those stories where it's like, all right, we have a customer acquisition cost, but our LTV is 3 or 4 times that. So right now we're going to lose money and we're going to acquire customers, but they're going to be profitable in the future. You know the story. Xero is like a great example of it. If you were buying, I'm not saying this is Xero by the way, but if you were buying Xero when it was like spending money and losing money, that's okay. And also you ask, all right, well, where's the relief going to be though? Well, we've seen recently with Xero how much that's bumped forward when they've actually crossed over into cash flow positive. And I think there's a potential similar story, maybe not as compelling a company, but a potentially similar story with Siteminder, because they are heading towards cash flow break even based on their most recent results. And if they get there, then I guess, I think that there is potential uplift. Now, you could argue the share price has been on an absolute tear lately. So you could argue, all right, well, no, that change in narrative is already priced in. And that could be true as well. But the point is, if the change in narrative, it's not proven yet, right? So they're still loss making, they're still cash flow negative. All I'm talking about is that they've gone from what you might think of as just an absolute dumpster fire of cash to getting closer to break even.
They brought their break even target forward by 6 months, I believe.
Yeah, so that's it as well. So they're also bringing forward when they think they can get to break even. I think they're supposed to be break even by the second half of FY 2024. So, if that's true, that's a pretty good trajectory that they're on, given that for the full year ended FY 2022, they lost over 110 million, and in terms of their cash expenditure, you're talking about a similar amount basically. Actually, not quite as bad on the cash line. I think about less than that, but at the same time, they've improved on the cash this time. So operating cash flow went from 2022 being 30.5 million to a loss outflow of 15.6 million in FY 2023. So the fact that this is less, like these aren't as ugly figures as the actual losses, does point to some of the benefits of their business model, obviously. Yeah, given that they've got cash still in the bank and given the reduction in their cash burn, by the way, they still do have about 23 million in development costs or payment for intangibles, which I assume is mostly software development. So, I think that they've still got a way to go. I'm not super confident on what their guidance means, etc. But at the same time, the directional implication is super clear, which is that maybe we're setting up for free cash flow positive for the full year in FY 2025. They use a lot of underlying kind of numbers as well, so I don't know what could be interfering with that. I tend to think, generally the statutory numbers.
Andrew's a billionaire on an underlying basis, aren't you, Andrew?
Absolutely. Particularly if you emphasize the second part of the word.
Anyway, in conclusion, probably the setup that I would be looking for would be the share price loses some of the excitement we've seen recently as this narrative has taken hold a little bit. maybe people forget about this narrative that I just said about how it could get to cash flow break even soon. You get a bit of a lower price, but that narrative is still hold, but they're still on the same trajectory. That could look pretty interesting to me. I'm not saying that'll happen, but if it does, someone remind me, because I definitely want to take a close look at it then.
Yeah, it's an interesting biz. I was going to say the Bailador have a strategic holding in this. I rate them a lot.
We should say what it does, though. I feel sorry for anybody who didn't listen to the podcast.
that's
Like a year and 3 months ago, we're like, continuing on from June 2022 discussion.
Well, they do. They've got a booking engine for hotels and whatnot. So it's sort of, it's a little bit
rundown of it then, Andrew.
Yeah, I mean, look, it's. I have to refresh myself. I was actually thinking I need to reach out to Sankar again and get him to come and give us an update. I find it a very opaque industry, in terms of how all the hotels and the booking.coms and all of them integrate and plug in and network.
They manage those connections for people that have inventory they need to sell.
Exactly.
Through various sites, because all the hotels are on everything, right? It's not like some things are just on this or that, but most things are on a lot of different platforms.
Yeah, it's just a genuine network effects at play here. Is obviously a massive market. There's definitely big inefficiencies in how things are sort of managed at the moment. I guess what's kept me away, I don't know if I mentioned this at the time when we talked about it last year, was just really having a clear understanding of those industry dynamics. I mean, even the big Silicon Valley tech firms have all wanted to sort of try and get into this. Google's tried to sort of disintermediate a lot of what's been going on there. And I'm pretty sure I put that to Sankar at the time, but it's hard to deny the numbers, right? Like forgetting the share price. Like if you just look at what they've delivered here, it's just sort of like LTV, revenue per user, revenue growth full stop. It's just sort of up and to the right, and I'm just looking now at their latest results, still guiding for 30% compound annual growth in revenue for the medium term. So it's interesting opportunity. Seem to be so far executing, massive market. I don't know. Seems interesting.
Yeah, I think it is interesting. I guess I'm just looking through, it's only maybe negative is property count growth was, I think, around 12%. And it kind of gets to something that I mentioned when we talked about Zero as well, is like how much the growth is coming from pricing. Like this is obviously getting a big rebound from transactions and a shift to more transactional revenue. I kind of like to look at some of the underlying growth measures sometimes to see, because at the end of the day, that's what's going to fuel how long you can grow for at a high rate. So I guess I'd want to see that probably pick up over time, the subscription properties, I'm thinking, or at least be able to sustain, 12% for a very long time to get there. Because if you think back to when Zero is at a similar point, it was growing a fair bit faster, I think, on an underlying basis. So that's probably the only other point I'd say.
Yeah. Oh, and the other thing too is, if I'm reading this right, what is it? 151 million in revenue, and the company is trading at 1.252 billion. So, man, what's that? 7-8 times sales?
Yeah, I mean, you need to get to how much cash do you think you need to get to in this eventually, right? You need to be eventually you need to get over 1.2 billion of cash out of the business, right?
Right.
To justify it, plus the cost of holding. So, yeah, I think that's fair. You have to think that it gets to 50 to 100 million of free cash flow. So revenue needs to go up quite a bit.
Interesting.
Any other thoughts?
Not excited about it, but one to watch maybe.
I mean, that's the thing. Again, I think too often we like to pretend that we're totally market agnostic. We're not. If I had this is my startup, and we were just catching up at a beer and he was like, hey, tell me, how's the business going? You'd be like, holy shit, that's really impressive. Like you would, right? Maybe just more surprised that I was capable of doing something like that. But you'd be really impressed, I think. And even if I was to sort of say, well, yeah, I mean, we are still bleeding cash, but this is what opportunity we're chasing. And here's the clear objective metrics that sort of demonstrate that we're at least on path to getting that there. And yet we go, oh yeah, but the price was really dumb and then it fell down a long way and therefore it's bad. And like, is it? Or was the market just dumb to trade it at like 20 times sales at one point? I don't know.
Mm-hmm. Yeah, no, very fair.
I feel like it could definitely come down a bit. I don't know what you guys thinking of the general market at the moment, but we had a bit of a good time generally in earnings season, and we've had a good run on the markets for a while. And I think the last week or two, maybe we've been seeing some of the wind come out of the sails of those growth stocks. There's still some that are pretty strong. I don't know. I don't know if you agree, but I feel like I've been witnessing overall probably a bit of a risk-off sentiment on the market, and especially with the growth software stocks we like so much.
Yeah, I was gonna say, I think that's probably true. I don't put, like, for my approach, I don't think about that as much. I do think about economics though, so I wouldn't say like I ignore macro. So for me, it's probably thinking about like, well, just how much long-term rates are. Long-term interest rates in the US are like almost 5%, and that's, if you add that to a risk-free rate, everything should be trading at lower prices, basically, I guess. So that's probably a way of framing it. It's more from a valuation approach that I don't think everyone's been assuming we get much lower rates very soon, and I don't have strong views on it, but I definitely don't have that assumption as like with any conviction. I think we could have this for a long time.
There's also surely an element of like it does portend weakness for stock markets, because if you got cash to deploy, then you're getting a decent amount for the first time in ages just by leaving it in the bank.
Yeah.
And it's like when it's 0%, you kind of want to play with it more than when it's 4.5%.
Oh, totally, 100%. That's a huge driver, man. And that flows through the whole financial system, right?
Yeah.
Except property. Property, we're still happy to have negative yields on. Sorry, I had to put that in.
Property sucks as an investment right now. Like, for all I was saying before, that was a whole plan about how to add value and make money. Like, in terms of just buying it for yield, I don't see it at all. I've been looking at number of different markets just to see if you can get anywhere near anything sensible on yield, and I just can't get there.
What's your point? It's just why I'll take a term deposit, risk free. Don't have to deal with bloody agents or tenants. Like
even the rental yields are lower than the savings rate. That's what blows my mind.
Yeah, it's pretty crazy. Hey,
I guess you could expect rental yields to increase, right? If you have a lot more rent inflation. If we don't solve the housing problem,
no, I don't buy it. Don't buy it.
it.
No, I mean I buy the idea. Look, the idea that, and this is going to sound mean. I don't mean it to be, but like any rational landlord should be charging as much as the market can bear. In fact, that's just business. Like any pricing strategy should be how much can I charge for this, right? I'm not charging. Woolies isn't charging less for its milk to be nice. It's like there's an economic calculus at play here, and landlords in all times, good times and bad, will always charge the maximum rent that they can, right? Unless they have a clear charitable angle to their investment, in which case, good on you. But that's unusual, I would say. And I think where the difference is with buying a house, when I'm doing it with funny money that's just like poofed out of thin air, the bank just goes, here you go, right? Like we've talked about it before. Right? How much can I pay? How much can I borrow? Right? That's how much I go to auction with. When it comes to rent, it's sort of like, well, you might feel as though you need to put the rent up another 15% to make the calculus work for you. I just physically can't do it. I'm at the edge already. And I think every stat kind of says that. And you also get to a point as where there's two lines on the chart that cross at a point where it's like those that can afford $1,800 a week in rent are the kind of people who aren't renting because they can afford a mortgage, right? So you hit an affordability limit because rent is paid from real income. Like that someone has had to work to generate. It's not generated from a fractional reserve Ponzi. Anyway, so I don't buy the argument.
I love how you segue one unexpected rant into another rant almost. Maybe we should cut it off. Claude just zoned out. No one's watching it.
Here he goes. I'm going to go get a coffee. I'll be back.
Hello, darkness, my old friend. Yeah. No, I agree with everything you said, or disagree. I'm not sure. I think you're making sense there, Andrew. People charge what they can. And,
of course they do.
Yeah,
of course they do.
But if we have more immigration, wouldn't that make sense? We don't have enough more housing supply.
Don't buy it.
Rents go
don't
up.
buy it.
What's the 10-second version?
The 10-second version is if all of the immigrants are investment bankers and surgeons, then okay. But they're not. Right? They're not. They're fruit pickers and hospitality workers.
I'm not saying house prices go up. I'm saying rents go up. And so rental yields go up over time. Does that make sense?
You get a job in an aged care home and see how much of rent you can afford.
Property prices go up all the time.
It doesn't.
I'm stepping it there one at a time.
all else being equal, obviously more demand will be a positive, right? Like obviously, and that's the first level thinking. Oh, immigration, ergo more demand, ergo prices are sustained. Like that makes sense, but there is still a very, very real affordability consideration to it.
Prices come down. Is that also possible?
Well, it's possible. Yeah.
All right. To summarize your thoughts on Siteminder, Andrew.
So on Siteminder.
No, we took you off topic. That was enough.
No, I did it to myself. Sorry,
All
everyone.
good.
I'm sorry.
No, it's good. All right, cool. Should we any more? Should we wrap it there, gents?
Just one quick funny story. So we had a strawman catch up in Sydney the other day.
Oh, cool.
Yeah, so it's really cool. Caught up with some members, and of course, I teed off on property. Like I just did. And
Did you stand at the table with your arms out like the Last Supper?
You up the end there? Stop talking. I've got a point to make here. And I caught myself at a point. I was like, oh my God, I really am a one-trick pony. I'm sorry.
You know, this is a stock market forum, right?
Yeah, I know. Apparently. It's like, yeah.
Everyone needs some comedy rants to like.
Yeah.
Very good. Cool. All right.
Okay.
We'll wrap it there. If you have any thoughts or suggestions, hit us up on Twitter @BabyGiantsPod. Until next time, thanks very much for listening.
Thanks, everyone.
Yes. Bye.